Welcome to FinTech Confidential, bringing you the people, tech, and companies that change how you pay and get paid.
Take no for an answer. I think I learned it the hard way. Everyone says don't take no for an answer. It's really important to take no as a signal.
I'm frustrated with the fact that it feels like when we look at credit scores, it's a black box.
The elephant in the room is that the banks aren't purely using the credit score. It's over-indexing on one metric, the FICO score. It was built for one use case and one type of consumer. It's not just FICO that's a problem. Fintechs that are coming up with their own scoring based on cash flow underwriting. I would consider myself to be an outsider to financial services. When you come with an outsider perspective, you are not corrupted by how things. Sold my last company to a bank, actually, and then founded Solo to disrupt customer data collection for banks and lenders. Solo is building a bureau of one. We look at every consumer and every entity as a unique profile. What is your annual revenue? I could give you 3 different numbers, depending on where you're looking. The banking sector, for the longest time, has been built around trust. And trust is a very interesting word.
Here's a quick message from the Accrued series sponsor. As default rates continue to rise and margins compress in lending, financial organizations are searching for solutions to combine that operational efficiency with innovation. Look no further, as LoanPro allows lenders to enhance their origination, servicing, collections, and payments using the foundation of a modern lending core. Check out loanpro.io to learn more about how over 600 financial organizations have modernized their tech stack with LoanPro. Welcome to Accrued, the FinTech Confidential series presented by LoanPro. In this series, we're deconstructing the complexities of lending and exploring compliance, optimization, modernization, and personalization through insightful conversations with the industry's best. I'm Ted Huff, and with my co-host Colton Pond, we'll be guiding you through the intricate lending world. Whether you're deep into lend tech or just intrigued by how the technology is reshaping lending, you're in the right place. And now, let's dive into another episode of Accrued.
Georgina, I am super excited to have you on. The Solo product has got me super stoked, and I've been looking at it, and it, in some cases, makes me a little frustrated, but it makes me excited at the same time. So I'm super happy to be sitting down with you.
Thank you. I'm excited to discuss what frustrates. Tell me more.
We're going to dive in deep for sure. When we first met, you said that you were a data scientist turned fintech. Explain that a little bit.
So I would consider myself to be an outsider to financial services. I don't come from a banking background. My first kind of entry point into fintech happened during COVID, where I founded a lending company in the Middle East, actually. And it was the first time that I had gotten into what the data collection process looks like for banks and underwriters. And I think that the advantage that my team and I had was that we were all outsiders to the banking space. And I think when you come with an outsider perspective, you are not corrupted by how things are just because the way they've been. You try to look at things through like a first principles perspective. And so I was trained as a data scientist early on in my career. And the context was different. It was in cybersecurity, but the methodology is the same. In my first company, when we were collecting data from borrowers, it was very much like, how do we verify and standardize the data that the customers are self-reporting, and realized it was a very expensive process that didn't make any sense. And it's a process that the banks and lenders still struggle with today. And so sold my last company to a bank, actually, and then founded Solo to disrupt customer data collection for banks and lenders.
You brought up a great point of people that come from outside of financial services. They don't come with that perspective of, oh, I just do this because it's how it's always been done before. So when we look at lending and credit specifically, how ought it to be from your perspective?
I think that the banking sector for the longest time has been built around trust.
Yeah.
And trust is a very interesting word. When we talk about trust, it's the long-standing relationship that you have with your bank. When I think of how financial services ought to be, it should be built on a system that doesn't require trust. Trust inherently is restrictive and also full of bias. And so trust is built on verification, but it's also built on you and me having the same definition of something. So when you ask Solo as a customer of a bank, what is your annual revenue? I could give you 3 different numbers depending on where you're looking. So trust isn't just that you're relying on me saying the truth. You're also relying on you and me having the same definition of something. And so the future that we imagine in financial services is one where you, as a customer, whether you're a business or you are a consumer, have this live database that contains everything. It contains verified financial statements. It contains like a raw repository of your payroll, all your income, all your financial affiliations, whether it's with other banks or your customers or vendors. And it's this live system of record that can be shared on demand with different stakeholders, but it allows the stakeholders to control how they're ingesting that information so that when we talk about income, you have your definition of what income is. You're not relying on me and you to be speaking the same language. And so by virtue of that, we imagine a world where trust is not built over time and is restrictive and locks a lot of people out of the system, but it's something that is granted based on an existing track record, even if you meet someone for the first time. That live system of record is possible today because we live in a world now where everything can be integrated. And so I can have access to your payroll. I can have access to your accounting systems. I can have access to all of your affiliations, and I know that they're verified. And especially if I have the tools to be able to make sense of them and query them in the way that makes sense to me as a bank or lender, then you don't need trust to be able to do this.
When I said frustrated, reason why I went down that route is I'm not frustrated with Solo. I'm frustrated with the fact that I'm frustrated with the fact that it feels like when we look at credit scores, it's a black box. I don't know what they're measuring. I don't know what they mean when they look at my income. I don't know what they're looking at. So I don't know how to position myself in the best light in the marketplace. I'd love for you to go a little bit deeper into you're changing the way we look at that.
I'm glad you asked. So our product that's live today focuses on the financials that are currently self-reported by a customer. And so if you think of a bank or a lender, there's a 2-part process to collecting data before a decision is made. The first part is there's this usually very gnarly PDF application that the bank will ask you to fill out. And it's a very high friction process. What happens on the back end is the bank will then take everything you're saying about yourself and they'll compare it to raw data because they don't trust you or they're trusting and verifying. And so they have their own recalculation of everything. That process is very expensive. And that's actually the elephant in the room is that the banks aren't purely using the credit score. So the credit score is just an approximation of your ability to repay. It's over-indexing on one metric, which is your repayments over time. What we're seeing more and more is if they're paying a couple of dollars for a credit score, the banks, they're actually spending between $400 and in some cases with the banks we work with, we hear numbers from like $400 to $6,000 on a process which is very expensive, collecting data from the customer and then verifying and standardizing it. The credit scores were built like, if you think of the FICO score, 1980s, it was built for one use case and one type of consumer. And the use case was credit card underwriting. And that's how they assessed credibility for one product. At the time, most people's earning behavior looked very similar. It was very common for someone to graduate college and stay at the same job until retirement. Whereas now it looks very different. Most people have more than one income.
Various different income sources. Yeah.
Also, investing wasn't democratized in the 1980s. And so you didn't have income from any other sources. I think the FICO score works in some contexts. There is no way that you could look at a number as an institution and be able to make a yes, no, and interest rate decision on every product in your portfolio. So I think the problem with it is it's over standardized. It's not just FICO that's a problem. It's you have now a bunch of fintechs that are coming up with their own scoring based on cash flow underwriting. And as a data scientist, I think that there's a flawed premise behind the idea that one score can rule them all. I don't think that a cash flow score can be used for a lot of different scenarios. I don't think that the FICO can be used for every product either. It carries the same problem that the FICO does, which is it's over-indexing on one attribute, essentially.
You say that no one score to rule them all. What's the future look like then? How do we move forward in a meaningful way to, for lack of a better word, democratize credit?
Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how.
So Solo is building a Bureau 1, is what we call it, which is we look at every consumer and every entity as a unique profile. And I think what the future of credit looks like from a scoring perspective is there's going to be an unbundling of the score. You have attributes that go and make up the FICO score. You have attributes that go inside of the cash flow scores. And I think what the future of credit looks like is the ability for a lender or a financial institution to decide what attribute makes sense in what context. The number means very little. It's the context in which you're operating. So it's looking at you from the lens of like one number is very hard because we're in a constantly evolving financial landscape. So trying to put one number and make that make sense for every institution, which is impossible because everyone has their own risk policy, different repayment schedules also, like your earnings and cash flow position might be ideal for one product, but not ideal for another. And so I think the future of scoring is essentially not standardized. So I think over standardization is the enemy, at least for us.
It's interesting as I think back through, and states like New York came out and basically said, hey, you can't just use the score as a decision maker. You can use it as a data point, but you can't use it as the overall decision maker. How do you see with the bureau that you're building out, pulling that together to not fall into that same space?
So we pride ourselves in being able to have like a 360 on the customer, and everything is user permissioned at Solo. So we're quite pragmatic in that we know that a bank will always need to pull third-party data sources in from the bureaus, and that there's a place for that for sure. What we aim to be is a live system of record that's connected to the internal operating systems of the customer. And so at any point, you'd be able to share that on demand, and then the institution can decide what attributes are relevant in this context. I think it's very important that consumers have a say. This actually isn't that disruptive. When you actually come down to first principles, as a bank, you are asking the consumer to self-report their information. The difference between what we're proposing and what exists today is that we're actually verifying it, standardizing it, and allowing the institution to decide how to control the inputs that the customer is doing. But those attributes are already being collected. When we talk about a consumer permissioned bureau or the fact that you have this live system of record that can be shared on demand, I think it sounds sexier than it is. I think it's already been being done, but that's kind of how we imagine consumers being involved in the credit reporting process.
Yeah, in a more verified way that you can trust and immediately build trust on because it's verified. You're a solo founder, no pun intended by any means, but rarely I feel like do we see solo founders anymore. Give us key insights, advice, learnings, 2 to 3 like really insightful takeaways from the past 2.5 years that you would give to someone that's on the other end being like, hey, I'm thinking about starting a fintech company or doing a startup.
I'm going to add one extra piece into that. And
please,
one sentence.
Great.
I actually have one. Take no for an answer is my advice. I think I learned it the hard way. Everyone says don't take no for an answer. And I think sometimes founders take that as being unable to recognize when the market is saying no. It's really important to take no as a signal. No just means there's no alignment. And that might just be true today. It might be bad timing. It might be that stakeholders aren't ready. The vision that we have for Solo is so much more disruptive than the product that's in the market today. And part of why that's true is you have to be pragmatic about what is viable today.
Yeah.
And so as founders, we want to challenge the status quo, but I think it's very healthy to, and sobering to take no as market signal. It could be regulatory signal. It could be the signal of a lack of alignment. And sometimes that means pivoting or changing your approach or just railing it in a little bit and then nurturing the market towards your greater vision.
Here at Strategic Advisory Board, one of the things our EVP of product, Colin, brought up is the Raptor 1, Raptor 2, Raptor 3 from SpaceX. And if you look at the pictures, the Raptor 1, it looks like shit. It looks like it could fall apart and you can pull it and it would just like, completely fall apart. But it went to space.
It did.
It went to space. The Raptor 3 looks really good. It's indestructible. Both went to space. And you need to start somewhere, ship it, learn feedback, and iterate from there. Well, is what I'm hearing.
And what's even interesting is if we use that as an example, Georgina, you were talking about being an outsider and looking at things. If you look at that exact same scenario, those weren't rocket scientists building the rocket. They were just engineers that were trying to build a better rocket.
Yep.
And taking that same approach and looking at the same problem from a different perspective. And I love how you said taking no as an answer. And I even really appreciate that you clarified the fact that it's like, no doesn't mean never.
Not now.
It means not now. It means not the right fit. It means not the right alignment. It doesn't mean that it's wrong. And I loved you brought it up that way. So I really appreciate sitting down with you today.
Thank you.
Yeah, thanks for being on, Georgina.
This is fun. Thank you, guys.
Well, folks, that does it for another episode of Accrued. If you've made it this far, go ahead, like, share, subscribe, all that fun stuff. And don't forget to sign up at fintechconfidential.com to be alerted on your favorite episode coming up next. And as always, keep moving forward. As we wrap up today's episode, I've got one last thing for you. If you're in the trenches fighting fraud and financial crime, you know it's a complex battlefield. That's where Hawk's AI tools for real-time payment screening, AML, transaction monitoring, and dynamic customer risk rating come into play. These aren't just buzzwords. They're game changers designed to make your compliance more effective and less of a headache. Imagine slashing through false positives with precision and giving your compliance strategy the edge it needs. Head on over to gethawkai.com to sign up for a demo and discover how their platform can revolutionize how you fight fraud and financial crime.
This has been a production of DD3 Media with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile financial assets, so research and make your own financial decisions.